Hello, my name is Mike Feiner, and welcome to the Final Wealth Report, April 2025. I thought now would be a very good time to talk about tariffs and the uncertainty in the stock market, since that's at the forefront of the complex financial topics that are happening right now. Now, during this turbulent time, today we're going to be talking about something that's caused a lot of white noise in the financial world, and that is tariffs and stock market volatility. If you're feeling anxious about the market swings and the so-called trade wars and tariffs, you're not alone. In this episode, we're going to explore how tariffs impact the stock market, and most importantly, what you as an investor might like to uh, do about it. So let's dive in. First of all, what is a tariff? A tariff essentially is a tax imposed by a government on goods and services from goods that are imported from other countries. They have a ripple effect on everything from the price, obviously, of the goods that you buy at the store to the profitability of the companies in the stock market. In the case of the tariffs that are occurring now in the Trump administration, it's sort of a trade war where we are imposing tariffs to do two things. One is to raise revenue, since we have a massive deficit in our revenue versus expenses and our trade deficits. Secondly, there's a fairness component where certain countries are charging high tariffs for goods that are imported into their countries, where we are not imposing the same tariffs on goods that are coming into our countries from their goods. As a result, this so-called international trade war, and it's causing a lot of volatility. Typically, we face higher production costs and we lose some access to these important markets during these times. As a result, stock prices can fluctuate and sometimes dramatically, as they've been doing in the last few days. It's important to understand, though, that while tariffs might have headline impacts, the markets are very resilient over time. And our long-term strategies are very important to keep in mind at this point. And we should take a look at not reacting too much to the stock market noise that's occurring. Although there are opportunities and there are issues of defensive strategies that we want to, take a look at this time. Let's talk about volatility. This relates to the ups and downs in the stock market, and certainly everyone's feeling very unsettled at this point because of the tariffs. We hear about tariff hikes. We hear about the reciprocal tariffs from other countries, especially the increase in the tariffs by China this morning. And as a result, the markets are very emotional right now. We can get swept up in that. But the volatility is the natural part of investing. And even though it can be very scary, it's something that we've been dealing with for a very long time. Now, what should we think about during this time? I look at this problem of tariffs, interestingly, that they're dealing with the right problem, meaning that we have a massive deficit that we have to deal with in the US economy. We have over $30 trillion of debt, so we have to reduce government spending. We have to increase revenue, which tariffs do. At the same time, we have to do it in a way that we can be balanced. So while we want to add revenue through tariffs and we want to be fair with regard to a car that gets produced in the United States versus a car that gets imported from another country. So as an example, if a German car comes into the United States, it pays a lot less tax than if a Ford gets exported to Germany. That part of balancing the tariffs makes a lot of sense. And it also, in the long run, can lead to more jobs being reshored to the United States. And that's sort of one of the bottom lines. The problem is building plants and reshoring assets into the United States takes quite a long time. However, the initial tariff impact is in the short term. So to put things in perspective, tariffs imposed are not new. They've been happening for thousands of years, actually. But more recently, in the 1980s, tariffs were imposed during the Reagan administration. Though there was some initial volatility over time, the economy grew. We worked out some of the trade wars, and the stock market, worked itself out. What are the takeaways from this? While I don't necessarily like all the ways that we've been implementing these tariffs, and it has created a great deal of uncertainty and volatility, I do think they are addressing the right problem. The problem is the biggest problem that we have in the economy, which is this massive deficit that we're running, as well as our national debt. So we are working on that problem through tariffs, and of course, kind of through the Doge, a government issues where we're trying to get rid of waste and some of the shocking expenditures that we're making. If we do those two things, where we can raise revenue, eventually reshore assets into the United States, and where we can reduce our deficit to some degree, that's obviously a positive. Doing it where we're basically imposing tariffs on 60 plus countries simultaneously is going to take time to work itself out. Hopefully, rational minds will negotiate with each other in different countries, and we will be able to bring this to a softer landing, where in the long run, we provide more jobs, which is the bottom line. So what does this mean? It means that we are experiencing short-term volatility, which was anticipated, because typically the first quarter or two of a new presidency is volatile. As a result, give us a call anytime, as we are going to work through what the short-term volatility will do from both a defensive strategy as well as opportunities for a portfolio. If you have any questions, as always, please give me a call at my cell phone, or send an email to michael.finer@finer.com. Thanks so much.